Welcome to the advisory group's fourth quarter 2025 quarterly context broadcast. Welcome. There have been a number of interesting news and market developments as usual, but as also usual, there's really nothing fundamental that should change what people do with long-term strategies, but it can be helpful as context for investors, whether individuals or endowments or retirement plans, to have that type of context, to be informed, to remain comfortable towards maintaining a long-term strategy that meets your goals. We will cover a number of topics today, including some general headlines, as always, economic metrics at the high level that give an indication of where things are, always some patterns that matter. There's some polls that suggest that consumers are unhappy about the economy. However, risk of recession probabilities estimates have gone down a little bit despite that. And we'll talk about other elements, including what asset classes some are suggesting will do better in the near term, even if that's not relevant for long-term investing. And then we'll provide an updated set of data regarding capital market projections for the 2026 numbers for 10-year outlook. As always, the key things to focus on are those that reside in the space between the things that matter and the things that you can control. There's a lot of things that none of us can control: the economy, political policy, the weather, international relations, inflation, interest rates, but we can control how well we plan and strategize, taking those uncertainty elements into account, building that into assumptions, understanding that those variables should not throw off a long-term plan if it's adhered to properly. So always important, always critical to focus on that middle space. The advisory group, for those that are less familiar, is a fee-only financial advisory firm helping an array of client types and focused on clients first and focused on having a positive impact on our personal wealth clients and their family members, the communities that our endowment or endowment-like clients serve, and the plan participants of retirement plans. As for metrics, high-level summary is that there were 2 rate cuts during the fourth quarter of 2025 by the Fed, each a quarter percentage point. That brought the Fed rate range down to 3.5 to 3.7. And this follows 3 cuts in 2024 and 11 hikes in a couple of years preceding that. We'll talk more about those cuts a little later. The inflation numbers have shown a little bit of cooling, which is a good sign from the Fed's standpoint. The Fed is seeking inflation at a target rate of around 2%. And the more inflation cools, the less likely the Fed will have to raise rates. And raising rates would make the markets very nervous. And this is all coming after a higher inflationary period, with the peak in June of 2022 at 9.1%. So not too long ago. Now we're about a third of that, but still above the Fed's goal. In terms of returns, the S&P 500 is one measure of the markets. That's large cap US stocks. However, about 30 to 35% of that return comes from a small number of stocks, oftentimes referred to as the Magnificent Seven. That return for the quarter was 2.7%. Pretty strong for the year, as we'll see later. Bonds at 1.1%, which is quite a solid return and annualizes out to something right around the long-term projected average. Unemployment numbers went up a little bit. This is a concern from the Fed's standpoint. So despite the rate cuts, and some of these employment numbers are delayed, so it doesn't include performance, and the government shutdown delayed some of the data gathering and publishing. So these numbers may be refined over time, as they often are, preliminary numbers versus final numbers. But overall, inflation, or unemployment rather, has inched up. So that's the Fed. That gives the Fed more reason to continue to cut rates to try to stimulate the economy, to try and increase jobs. And with inflation cooling just a little bit, that may give the Fed a little more space, although the Fed doesn't want to overdo it. Then if we look at GDP, gross domestic product, or a measurement of productivity of the country, that went up to 4.4%. There was consumer and government spending that increased. Exports also had a boost, which also boosts GDP. However, the projection for the fourth quarter, those were third quarter numbers, 4.4. The fourth quarter numbers are projected to be cooler by more than 1%, at around 2.7%. A few other highlights. The government shutdown was happening at the beginning of the quarter and then ended mid-quarter. It was the longest shutdown in U.S. history. The unemployment rate is at its highest in 4 to 5 years. Inflation, as mentioned, is cooling, but remains fairly persistent at a higher level than the Fed would like to see. Overall, stock market returns are pretty strong, especially at the year level, despite the complex dynamics in Washington and the related tariffs and so forth. So investors are looking past that a little bit, but some of that momentum has the possibility of cooling, as always, especially if there are concerns, and there's been more volatility recently around questions about the sustainability or timing of impact of AI and the surrounding elements of that, as well as other market dynamics. Tariffs remain relatively stabilized, but there's been talk in the last month or so out of Washington about increasing tariffs for European countries if they don't get on board and support the idea of the U.S. purchasing Greenland. So that's an interesting geopolitical dynamic. And as mentioned last quarter, that 17% approximate level of tariffs is the highest since 1935. And in 1935, those higher levels triggered a depression. Now the Fed has better tools for trying to avoid depressions, but that doesn't mean there couldn't be an economic cooling and some sort of recession. We'll talk more about that later as well. International stocks have been very strong, 32% for the year for developed countries, 34% for the year for emerging markets countries, beating US stocks pretty solidly, although US stocks did well for the year as well. And this is rewarding investors who have been patient with international. As you may recall, if you're a client or listen in on this for a while, the US had been leading more consistently than is normal, and inevitably cycles revert, and current political and economic dynamics in the US, while reasonably resilient, still suggests some weakness in the future and a weaker dollar, and that gives international stocks and bonds a boost. The dollar remained flat, or flat after some stabilizing last quarter, but there's some weakening expected for the dollar. Bank of England cut rates, Japan increased rates, China's growth rate remains close to their target. Real assets solid at 13% for the year, but pretty materially under what the other public markets, stock markets, have done. So that's reflective of less inflation in the future than would be implied otherwise. And gold has had some pretty impressive returns, 64% for the year, but this is an interesting dynamic relative to what are strong stock market returns, because some of that gold is oftentimes referred to as a fear asset, and there's a the belief currently is that there's a combination of investors going into gold because of uncertainty about U.S. markets and the economy, but also that foreign investors may be buying gold as a proxy or a alternative to buying the U.S. dollar, which could lead to weakness in the dollar. But gold fundamentally has no intrinsic value or in terms of producing improved productivity or output or something that would actually drive improvement in the economy, and so can be very volatile in both directions. As always, there is news that causes markets to bump around. Won't dwell on nothing really dramatic here. We've talked about the shutdown and tariffs and other dynamics there. One item of note, just in terms of market specifics, is that NVIDIA, the AI chip maker, became the first company to have a market capitalization over $5 trillion. And that's been a pretty rapid rise to $5 trillion, going from 1 trillion to 2 to 3 and up to 5 in a relatively short period of time. And some would say they have a strategic advantage. Others believe that that valuation may be stretched and that other competitors will catch up sooner than the market believes, but time will tell. If we look at the 2025 overall market in review, you can see here in the dark line bonds and in the orange line stocks. So some pretty significant cooling in the early part of the year, and then a surprisingly strong rebound despite questions about tariffs and the economy and politics and so forth. So excitement about possibilities, and the real question is, while that's building wealth, there could be some cooling. How much cooling will that be? And I think the most valuable thing to remember for investors is that even if there is some cooling, if the market, for example, is overvalued by, just to pick a number, 10%, and it cools 10%, it's not that the fundamentals of a lot of companies are problematic. It's just that prices may have been stretched, and so that would bring things back to maybe where they should be, rather than necessarily implying a fundamental problem with those companies. So just a helpful reminder there. Talking more about return specifics, so the U.S. Market for the quarter up 2.4, international about double that at 5, emerging market stocks about the same. Global real estate cooled with increased expected yields in the future for bonds, which makes real estate purchases and refinancing more expensive, so that pushes decreases the valuations of real estate. And then bonds pretty stable at 1%, and global bonds at 0.5. Now, as mentioned earlier, if currency cools in the US, a currency boost abroad will be helpful for international bonds, as was the case last quarter, or not last quarter, but a few quarters before last quarter, and creates diversification benefits. The circled box here highlights the 5-year bond number. So bonds had a much more significant negative return over in the 5-year slot there until recently, because as interest rates went up, that pushes bond prices down, and there was the largest, fastest bond interest rate hike in history just a couple of years ago to try and control inflation. That really hit bonds and made some investors question whether or not bonds were still valuable in a portfolio, and they definitely are long run. Interest rates are really one of the few scenarios that can create significant short-term downside for bonds and stocks, although bonds went down much less than stocks. But the point here on this slide, by highlighting this, is that there's only now a very small negative return over the 5-year period, and pretty soon we expect that to become positive as the bond returns each quarter tend to create a higher cumulative long-term return over that 5-year number. So patient investors are being rewarded for bonds and stocks. Looking at the last year as well, it's really can be thought of as being broken into 2 periods. That first section in orange there, in that lower left, the market dropped 15%, really related to tariffs and tariff concerns and uncertainty. And the second half was excitement about stabilization of that tariffs and reduction in expected tariffs, even if they remain historically fairly high. can see in 2025, not a dramatic difference between value and growth and core. However, value did beat growth by a couple of percent in the fourth quarter. And as we'll talk about later, that's not surprising. And we would expect to see more of that off and on over the next few years, given reversion to the mean after large cap growth has done excessively well. Undervalued stocks will eventually get recognized and have some catch up in their returns. This chart highlights the 4 worst markets in the last 100 years or so. The top blue line is the current market, including the global financial crisis, the COVID market, and interest rate hike period, and so forth. And this is after inflation. And so we can see that the recovery was faster in this market. There's really more than one down market. This is really multiple markets here connected, but over this time period, partly because you can see that there have been periods in the past, for example, the Great Depression, where the markets took quite a while to recover. That's why there's been so much focus on the Fed to maintain the economy through inflation and employment to avoid dramatic downturns, and the Fed has been successful since then in avoiding that. Although you can see here, the other 2 worst markets did take around 13 or 14 years for full recovery, but that's very uncommon. And in the case of the global financial crisis, it was about 5 or 6 years. Stock valuations, as mentioned a moment ago, indirectly are at relative highs in recent history, as we can see here. So based on PE ratios, and historically, when PE ratios are elevated like this, there's oftentimes some cooling or some at least leveling out. And the S&P 500 numbers here are really boosted in many ways by the Magnificent Seven stocks mentioned earlier. So something to keep in mind is the makeup of the numbers within the numbers. If we look at across the world here, you can see US stocks are, which is really driven by a lot of those mega cap stocks, at the upper range, whereas other countries are much more attractively valued or have more normal valuations. Some multiple organizations, one cited here, are talking about what's likely to do better in the near term. Vanguard, for example, and their economists said that they believe, when asked these questions, so big versus small stocks, unclear at this stage. While even if large cap or mega cap stocks are overvalued potentially, or valuations are stretched, there may be strong beliefs in the power of AI, and it may take a while to find out whether or not the pricing is appropriate, or is that pricing really more appropriate for a much longer term view of AI, in which case maybe prices are a little bit overvalued now, and there could be some cooling and correction there. That's unclear at this stage. Value versus growth, based on reversion to the mean, Vanguard and we would expect value to have an advantage. Developed versus international, developed versus emerging. Developed may have an edge. US versus international emerging are expected to have an edge. And then international bonds are expected to benefit from currency dynamics and the weakening of the dollar. This, by the way, to be clear, is not suggesting that one should have a tactical change in a portfolio in the short run. This is actually more designed, the reason we're including these comments is designed to help investors stay the course for some of the asset classes that have been out of favor. And what these bullet points suggest is that the relatively out of favor stocks, even though international has done well in the last several quarters, is still lagging the US over longer time periods. So staying the course helps you benefit from the allocations you currently have, and we don't want and don't encourage investors to make big tactical decisions, to make big shifts, to try to bet in the short run, and to over-concentrate, because that can lead to bigger risks down the line, regardless of what asset classes are held, if anything is over-concentrated. Some value managers who have their own belief system, but also some rational thinking, believe that mega cap stocks will cool or could cool. And if they do, because they represent such a large portion of the index, that can really make an impact, especially for investors that are 100% passive. So the indexes are capitalization weighted, which means they hold a disproportionate amount of assets by capitalization rather than a more equal weighted approach. For tax deferred or tax benefited portfolios of clients of ours, we use a combination of active and passive to capture the market effect, but also have a more balanced and more diversified view so that there isn't such excessive sector type risk concentration by having so much in the Magnificent Seven. And data does show that when PEs are at a certain level, as mentioned a moment ago, it does tend to be followed by a period of returns that are more mild or sometimes negative. So that would point to, theoretically, some cooling in the Mag 7, but people have been expecting that might happen for a while and it hasn't happened yet. So that's why it's unclear, and the market hasn't figured that out yet. Not enough data, not enough real information. So those things just take time to play out in actual markets, actual companies, actual results in terms of productivity and efficiency and how they're implemented and so forth, and what the innovations are that affect different companies. And we would also expect that small companies will begin to benefit more in the future as more and more AI companies create tools and systems that would allow smaller companies to afford and implement more easily different types of AI. But on to this next slide, recession scenarios continue to shift. Not too long ago, middle of 2024, there was a 50% estimation of a recession, then it went up to 60%, and then down to 40, and now it's down to 35. However, right there in the middle, this losing balance segment, that's 30%, which is the biggest single allocation on this chart. And that is really a space that is right in between expansion and recession, and depending on the variables, could lean either way. So future versions of this chart, if some of those factors start to play out, some of that 30% would likely shift down to that recession category and increase the chance of recession. But there's a chance that the Fed and the economy navigate this very smoothly, and you have the fabled soft landing that avoids a recession, but may have some cooler economic activity without shrinking GDP. Unemployment, as mentioned, has inched up. That makes the Fed nervous and decreases consumer spending on average, even though consumer spending has gone up a little bit recently. Inflation, as we talked about, has come down a little bit, but not a lot, and still above the Fed's target goal. The Fed cut rates twice at that quarter point level. You can see how that's reflected here after a period where interest rates were essentially zero and then ratcheted up before COVID and then brought back down to stimulate the economy to prevent economy from going into a depression. And that, while uncomfortable and hurt jobs and hurt some people and income and other factors, it would have been much worse if the country had gone into depression, because it's much harder to get out of a depression and does much more long-term damage to the economy. The yield curve, which is a measure of the bond market or the bond market investors' view of the future, is continuing to evolve. Last quarter, it looked a bit like this current chart, except the short term was more pronounced in the inverted section here. A normal yield curve starts in the lower left and slopes up to the right. Here we can see that the current curve or past curves were fully inverted here back in 2023, still fairly inverted late in 2023, but currently normalized essentially for most of the curve, but still inverted a little bit at the short term. So that implies that bond investors believe there is more short-term risk to the economy and less long-term risk. Consumer confidence remains at a relative low after picking up some speed in the last couple of years. down at a low that we've only seen a few times back about 55 years. So with wage growth being weaker and inflation coming down, but prices not coming down, that's just the rate of inflation comes down, but prices remain relatively high, and concerns about other dynamics and higher rates, which is harder if you're trying to buy a home. A number of these dynamics have made the average consumer a little nervous. In terms of quality stocks, this chart is always interesting to us because when markets are hot and frothy and momentum oriented and risk seeking, that tends to benefit the prices of lower quality companies that have weaker balance sheets, that are more aggressive, that are taking bigger risks, and investors feel like it's worth taking those risks. So if you see red here, that means that is the percentage by which lower quality companies beat higher quality companies in each of those size and investment style categories. Where it's green, that's where higher quality benefited. So there is some green shown here, and this is also tends to be cyclical when there again are hot markets where people are more excited and aren't thinking too much about risk. There tends to be more red and more focus on lower quality stocks. And then when things tend to flatten out or cool, that's when higher quality stocks tend to perform better. And in client portfolios that we build, there's a blend of high quality and low quality with a bit of a bias towards high quality, because if we dampen downside a little bit for the same expected return, that can actually increase your compounding rate and improve your long-term return, even if that can lead to a little bit of a lag in the short run when more aggressive stocks might lead the way. Then we have the periodic table of returns. This shows year by year, different stocks, each stock categories and bond categories. And it's just a reminder, you can see there's no clear pattern. Every time you think there's a pattern, then it changes significantly. It's just a reminder of the unpredictability of markets and the importance of diversification. And the white box in the middle is a blend, a 60-40 portfolio, just as an example, that shows that when you are diversified, you never end up at the bottom. You don't get always the highest returns, but you always avoid the being fully concentrated in the worst performing asset classes. So it smooths out the ride. Projected returns update data from Callan are shown here. Not much change, only 0.05% projected change in returns in most cases. Emerging market bonds have a little bit more of a difference, reduced by about 0.3%. But overall, almost identical projected returns, almost identical projected standard deviation, with many of them being identical projections, especially in US equities and alternatives, but mostly in the bond space, there's some minor adjustments. So what this means is that we will be going through our annual investment committee process to review this and consider adjustments to asset allocation, portfolio design within a given stock bond mix for clients. And this means that changes are likely to be either very small or make no changes at all this year to the sub-asset allocation adjustments. That capital market information is also summarized here over time. Callan data showing what asset allocation would have achieved or was projected to achieve for a 10-year period a return of 7%, just to have a common baseline. And you can see in the pie charts how in 1996 you could do that almost with nothing but bonds, only 6% stocks. And then in 2011 it was a pretty dramatic shift. It really required a more balanced portfolio with only 35% bonds and the rest in stocks. 2022, with lower projected returns, it was only 4% bonds and a much heavier allocation to stocks. So risk really jumped up then, because higher stocks, higher volatility, higher standard deviation risk. And then 2026 numbers, actually projected 10-year numbers, look actually a lot more like 2011, even though it's a different environment with a somewhat of a balanced view, roughly 37–40% stocks and bonds, and the rest stocks, and moderated risk, even relative to 2022 year number. So overall, interesting to see how what's required to get a 7% return, just as an example. Then we have our rules and regulations corner. Won't go through all of this, but there are some tax implications for the OBBB, as it's called, that went into effect in 2025, or became law in 2025 to be in effect for the 2026 tax year. So you can take a peek at some of those elements there, and then we have a blog post you can follow here, or just go to our blog post, and you'll see that towards somewhere near the top. Take a peek at that. There's one of those elements of the OBBB is a new account type, 530A accounts, also referred to as Trump accounts. This begins in the middle of 2026, helps, you can get, for children that are born between 2025 and 2028, can get a $1,000 contribution from the government into an account that's Roth-like, and then parents can continue to contribute at higher levels into those accounts up until that child's age 18, or the child can make that contribution themselves if somehow they have income that they can contribute. So an interesting saving opportunity that's in addition to and separate from the regular Roth and 401k limits, but it's unlikely that people under 18 will be have 401k themselves yet, just because probably not in their working years. In terms of fiduciaries, Secure 2.0 updates around a number of elements that are optional and some that are gradually coming into effect over the current and future years. Alternatives and retirement plans, there's discussion in Washington encouraging an exploration of the use of alternatives in 401k plans. I guess there's some incentive by the president, who has a stake in crypto, to have crypto be included. Our view is that some asset classes, private equity could be interesting, but it's illiquid and it's hard to access for smaller investors if you're under several hundred million. Real estate, in terms of REITs, is something we already utilize. Crypto, again, much like gold, doesn't have intrinsic value, and so while it has done well, is a bit of a momentum play and possibly kind of a Dutch tulip scenario play. And so currently, at least the way that's structured, and it's not something we would encourage clients to include in a 401k plan or another retirement plan. And then, as has been the case over the past couple of decades, the environment, social, and governance rules or utilization of ESG funds in retirement plans has been encouraged or discouraged, and then discouraged. And the current administration in Washington is trying to make it harder to do that, and is requiring that retirement plans really focus only on financial factors. And that's just a status update there. New blog posts, should you wish to explore. Hopefully find something that's interesting to you, including new savings limits. We also published that separately on WealthStep, and some other videos on WealthStep for 401k plan participants, and eventually that'll be helpful for smaller individual investors as well. And we published recently a retirement plan fiduciary education video that is designed to be helpful. So anytime you have a new committee member, we would encourage you to circulate this link to them, and we can help with that. And we'll also be developing in the near future a video for fiduciaries that are involved with foundations and endowments or similar type nonprofit entities. So I want to thank you for joining us today. It's always our pleasure to help you have more context in a way that hopefully calms your nervous system. It doesn't eliminate concerns about the market or economy, but puts them hopefully into context, in the context of a long-term plan and long-term decisions, to stay the course in a way that will benefit you and the people you care about most, or that you're responsible for overseeing, such as a retirement plan. And with that, we will pause here in a moment and take questions. So if you have a question, please plug that into the box and we'll take a peek. Also, just in the meantime, I'm going to flip through these slides just for quick reference. If you see any of these you'd like to discuss in further detail, reach out to us and we will be happy to have that conversation.